Did Anthropic just cancel the entire market for tokenized pre-IPO stocks? Retail investors thought crypto finally gave them a backdoor into hot OpenAI, Anthropic, SpaceX, Databricks, Stripe, and XAI before IPO. But now Anthropic says any unapproved transfer, SPV, forward contract, or tokenized structure is void, meaning some investors may not own stock at all, just promises from middlemen. So is this the end of pre-IPO tokenized stocks, a major blow to real-world assets on-chain? And will other hot AI companies follow next? By the end, we will look at why Anthropic did this, how much value was erased, and the new ways traders can still speculate on pre-IPO companies without pretending they own real shares. My name is Zhenya, I'm a crypto investor since 2017 and the founder of Memecoin trading app Apin. Anthropic said any transfer of its stock or any interest in its stock needs explicit board approval, and this was not vague. Anthropic targeted unauthorized secondaries, SPVs, forward contracts, and tokenized structures. It also named platforms that facilitate the purchase of secondary shares, including Forge Global, Hiive, UpMarket, and OpenDoor partners. These platforms allowed investors to buy shares of private companies from employees or early investors. Private AI demand has gone crazy. Investors want exposure to Anthropic, OpenAI, XAI, Scale AI, and the pricing was wild. According to the source, secondary markets were pricing Anthropic at over $1 trillion, while its last official round was closer to $350 billion to $380 billion. So platforms created products to sell that demand: secondaries, SPVs, tokens, and economic exposure. But private company shares are not public stocks. You cannot take restricted shares, wrap them into an SPV, tokenize them, and sell them to thousands of people and assume the company will accept it. So the real question is, did Anthropic approve the underlying transfer? If not, the token may exist, the SPV may exist, the contract may exist, but Anthropic can still say, we don't recognize this. That means you may not own Anthropic stock. You may only own a claim against a platform, SPV, or seller. That changes the whole trade. If you don't want to buy some shady instrument and keep up with the market, press like for the algorithm and subscribe. Tokenized public stocks and tokenized pre-IPO stocks sound similar, but they are structurally different. If someone tokenizes Nvidia, Apple, Tesla, or S&P 500, there are still risks. You may not get voting rights, and you may not be the direct shareholder. It may be a tracker, a note, a certificate, or a contractual claim, but at least the issuer can go into the market and buy the public stock. Nvidia trades every day, Apple trades every day, and Tesla trades every day. So the risk is mostly about the wrapper: custody, redemption, issuer failure, and whether the shares are really there. Pre-IPO tokens have a deeper risk. The company can block the transfer, the board can reject it, and the shareholder agreement may prohibit it. So tokenized Nvidia has custody risk, but tokenized Anthropic may have invalid backing risk. That is what can kill the product. Pre-IPO token products like PreStocks, Republic Mirror tokens, and Jarsy were built around the idea that some structure holds shares or economic exposure and the token lets buyers trade it. It sounds attractive. You don't need to be a VC, you just buy the token. But if the company says the SPV is invalid, the structure starts to shake. PreStocks Anthropic token dropped 20 to 45% in one day, and OpenAI linked tokens also sold off. That is the brutal truth. These products are synthetic. No real ownership, no voting rights, no dividends, no guaranteed IPO recognition. You usually have a contract with the platform, the issuer, or SPV, not the private company. And now the company can say, this thing backing this product is not recognized by us. This is much worse than normal price risk. The official answer is investor protection. Private companies do not disclose like public companies. Investors may not see audited financials, revenue, cash burn, insider sales, liquidation preferences, debt, or the full cap table. So access is mostly limited to accredited investors and institutions. In the US, that usually means around $200,000 in annual income or $1 million in net worth, excluding your primary residence. But the frustration is rational. AI companies sell a world-changing story. They talk about transforming work, automating labor, and reshaping the future. The public is exposed to the consequences, but when the same public wants the financial upside, they are told they are not allowed in. This is the contradiction. The story is public, but the equity upside is private. That is why pre-IPO tokens looked attractive. They seemed like a workaround, but the workaround only works if the underlying exposure is valid. And this is the same pattern I covered in my video how Trump family exploited crypto industry and extracted billions. Public hype, retail belief, and insiders extracting value through crypto rails. Watch it right here. Anthropic is probably not doing this to protect small investors. After all, it's Securities and Exchange Commission job. It is protecting itself. It wants a clean cap table. It doesn't want an unknown SPVs, tokenized wrappers, retail claimants, or thousands of indirect holders creating legal uncertainty before an IPO or tender offer. There is also litigation risk. If thousands of people buy Anthropic-linked tokens and later Anthropic goes public, some token holders may claim they deserve IPO shares or cash. Anthropic wants to prevent that. The sources say OpenAI updated its policy around the same week, banning unauthorized transfers and SPVs. SpaceX has been strict for years. Databricks and Stripe use controlled tenders, and XAI reportedly still allows some approved secondaries for now. So this is not just Anthropic, this is the new private market line. You get liquidity only on the company's terms. Whenever a return looks unusually attractive, risk doesn't disappear, it changes form. In DeFi, yield can hide smart contract risk. In Memecoins, early access can hide insider supply. In perps, arbitrage can hide execution risk. In prediction markets, a good trade can hide resolution rule risk. And in private stock tokens, access can hide transfer validity risk. People thought they were taking Anthropic price risk, but they may have been taking legal ownership risk. If Anthropic grows 10x, but your structure is not recognized, the company's success doesn't help you. You do not lose because the company failed. You lose because you were never actually inside the ownership chain. That is why the word exposure is dangerous. The gray market version is probably in trouble, not because tokenization is impossible, but because the old model had a fatal weakness. We got private shares through some structure, now retail can buy exposure, just trust us. The private company can simply say, we do not approve the transfer. Once that happens, the product stops looking like equity exposure and starts looking like a legal dispute packaged as an investment. But speculation will not disappear. Retail still wants to bet on OpenAI, Anthropic, SpaceX, XAI, and other private AIs. The next version should not pretend to be a stock. It should admit that it's a speculation. The cleanest replacement may be prediction markets and event contracts. Instead of selling tokenized Anthropic stock, platforms could create markets like, will Anthropic IPO before a certain date? Will OpenAI reach a certain valuation at IPO? Will SpaceX or Starlink become public before a deadline? Nobody has to claim ownership of private shares. Another idea is private AI valuation index, tracking reported valuations, tender offers, fundraising rounds, secondary marks, and mutual fund marks. Another possibility is valuation perp, anchored to founding rounds, tender offers, IPO pricing, or other defined events. Again, this is not equity. It's a derivative on the narrative, and this is already happening. Crypto.com launched pre-IPO perpetual futures for OpenAI, Anthropic, and SpaceX, offering 24/7 leverage exposure settled in stablecoins. Injective reportedly had similar markets since late 2025, with Hyperliquid and OKX moving in the same direction. That is the market's answer. No shares, no cap table, no board approval, just cash-settled bets. But the risk moves into funding rates, leverage, oracle design, liquidation risks, counterparty risks, and volatility. If you already bought tokenized pre-IPO stock, an SPV interest, or a private company exposure product, the most important question is not what's the company worth. The question is, what exactly do I own? Do you own direct shares or an SPV interest? Did the company approve the transfer? Do you appear on the cap table? What happens at IPO? Do you receive public shares, cash, or some platform-defined payout? Can the issuer change the terms? If you still want exposure, cleaner paths are issuer-approved secondaries, regulated funds, prediction markets, or public market proxies like chips, cloud, power, data centers, software, and public AI equities. None are perfect, but at least you know what you own. The lesson from Anthropic and OpenAI is simple. Private company equity cannot be tokenized without the company's consent. A token can exist, an SPV can exist, a marketplace can display a price, but if the company does not approve the transfer, the product may not represent ownership. The next generation of products needs to stop pretending to be pre-IPO stock. The honest version is issuer-approved tokenized equity, or speculative markets based on IPO outcomes, valuation milestones, revenue thresholds, and private AI sentiment. Retail demand is not going away, but the biggest names will likely offer liquidity only on their terms. Approved tenders, controlled secondaries, or IPO. Secondary platforms like Forge and Hiive may survive, but mostly for companies that cooperate. On-chain perps, prediction markets, and volatility tokens may become the default way normal people gamble on pre-IPO hype. The speculation doesn't stop, it just becomes more creative, more leveraged, and more detached from actual ownership. In public markets, the question is, will the price go up or down? In private markets, the first question is, are you even allowed to own what you think you bought? Because if the answer is no, then the trade was never really about Anthropic, OpenAI, or SpaceX. It was about trusting the middlemen, and that might be the riskiest trade of all.